Welcome to Long Story Short, a podcast where two financial advisors, one rooted in financial planning, the other in investment strategy, break down the questions we're actually hearing from our clients. Each episode, we tackle one or two real-world issues that matter to high-net-worth individuals, from market-moving news to personal finance decisions with lasting impact. No jargon, no fluff, just clear, thoughtful insights from the front lines of wealth management. We keep it short, but we don't cut corners. This is Long Story Short.
So Adam, there's this guy on Twitter with the handle @CPA Planner who creates these massive Twitter threads about new tax legislation whenever it's about to become law. I feel like if this bit wasn't already taken, like you'd probably be doing this.
Yeah, absolutely. I feel like that's an important role to fill in the Twitterverse. You get all this market commentary, and sometimes taxes are like think about some of the jobs at the hospital, like being an anesthesiologist, where like 99% of the time it's pretty smooth sailing, and then 1% of the time, things get real serious, and the tax world is kind of like that. There's periods of quiet, and then all of a sudden it's mayhem, and that's what this is. And I appreciate all the communication, but it's also amazing to me. Like that's an example of someone who's putting good work out there and is reputable. But I've been more surprised at like the amount
Right.
of garbage I've seen over this tax bill
Yeah.
specifically.
I mean, things happen so
hmm
fast. When you point out there's over 900 pages, it's like it's hard to imagine that you can really become an expert at it so quickly. Yeah. So you're saying like you can't trust just everything you read out there on the internet, huh?
No, with obviously with investments and especially with taxes, just things like, hey, Roth conversions aren't allowed anymore, or this new type of deduction is only allowed if you itemize. Stuff it's usually in the minutia, but it's stuff gets thrown out
Mhm.
there. You don't know who's saying it and what their credentialing is, and this is what you have to navigate when these big changes happen.
Yeah. I feel like today more than ever, it's important that like you follow people and sources that you trust that have done good work in the past, right? Like the random account you see online, probably take anything that's said with a grain of salt. I know you put a ton of time and effort in understanding the tax bill, and the reason I know that in this little inside baseball here is our last podcast episode took 3 different takes to record before we finally got it to the point where you liked it. So that's what we did last time. You can find that episode on our podcast feed. You can also find your write-up on our blog post at berniewealth.com. But Adam, since you've already done all that, we're not going to re-record for a fourth
Thank
time.
you.
But just like, what would you say the main takeaways are for our listeners?
Well, the main takeaway is never to do a solo podcast again, but that's the first one. I much more appreciate having someone with me
it's hard just
for a
like to talk
conversation. Yeah,
solo for
talking to
30 minutes,
myself
right?
into a camera for 40 minutes is not probably not something I want to do again. But big takeaways, the 3 heavy hitting main items were: number one, the permanent extension of the current income tax rates, which everyone was worried about with them sunsetting this year. Number two was the 2 big changes related to charitable, deducting charitable contributions. So people that take the standard deduction, even if whether they're married or file single, now get a little bit of a write-off, either $1,000 or $2,000 for their charitable giving. Itemizers that make charitable gifts have a new 0.5% of income floor they have to worry about. And so those were really interesting changes on the charitable front. The third is a new deduction for seniors who either have income below 150,000 if they file joint, or 75,000 if they're single before they're phased out, of a $6,000 per individual deduction, which is below the line and allowed whether you itemize or take the standard deduction. So like a bonus deduction for seniors, essentially, meaning to replicate the promise about no tax on Social Security. So those are the big 3, and then also the extension, permanent extension and slight increase of the estate tax exemption amount, up to 15 million from almost 14, and 30 million if you elect
Yeah.
portability as a married couple. So those are the heavy. I think those are like the big heavy hitting planning items with some minutia underneath the surface for other people. But those are the things our clients are most going to be focusing on.
Got it. So those are like the big things in this bill that are changing or at least being extended. As far as like action steps, like what should people do to make sure they're taking advantage of all these tax
Well,
breaks?
some of them start this year, some of them start next year, some are permanent, and some are temporary. So what I would emphasize now that we're in July, it's like we're starting to hit a really good window to do some projections on, hey, here's where I landed last year um, under the old tax regime. Here's where I'm going to land this year uh, with the changes that are effective in 2025. So it's a good window to do that side by side comparison and see what's changing and how it impacts the bottom line and see what kind of planning goes around it. So planning around charitable gifts, planning around things like Roth conversions that we were more concerned about because of the potential income tax rates changing, become a little more. I'm not gonna say I'm not gonna say they become easier, but you can do it with a little more clarity behind the math. And something else I didn't mention on my very short list of fast talking points on the, OBA 1 minute drill.
It's 900 pages. I'm asking you to condense
The
it down.
salt
You're doing a
cap,
great job.
the salt cap deduction being bumped up from 10 to 40
Right.
for certain filers. So there's those. It just hey, see where you land on the spectrum with the new changes, and then think about the planning that might go around it because not every income year for everybody is the same. We have such certain varying levels of control on um, income and especially investment income. And so we might want to think about that and just use this new information for better planning. That's what we'll be doing. Um, so yeah, all good stuff
Yeah,
and hopefully.
it's funny. I sent a message out to Brent Sullivan over on LinkedIn about this, but like it's just like add to the list the things that you need to plan for with your
Mhm.
investments. Like we do a lot of work with our like tax aware long short strategy, and we've talked with Brent before on that topic, and we talked about IRMA tax brackets, and now I feel like we've just added to that list of like you just want to make sure you've got a really like you've got your hands around what your income situation
Yeah.
is if you're borderline on things like the SALT deduction or the senior deduction.
So it goes. Yeah, yeah. Just increases the need for more proactive, ongoing planning, and this is where the fun starts for us. And so we're already seeing, like in our tax modeling tool, the systems are being updated to start to model out some of these big changes, and we're really excited to do that and bring clarity to some of the noise that's happening. So all good stuff. We'll continue to communicate about it, but yeah, I think those resources are a really good starting point on the website and the previous podcast. But next time I'm bringing you along with me. That was my last solo shot, and I'm especially excited to have you back because I know one of the parts.
Well, it's payback though because yeah, I did one solo where I was interviewing Lowell, right? So now I've done my show without you. You've done your show without me. We're even
Okay,
now.
yeah, we're moving forward, and we're moving forward with some really great client questions under our belt. And I've got one. I'm going to put this on that Mount Rushmore of client questions when it comes to investing, and I'm throwing it to you because I know you're especially passionate about this, and I don't blame the context behind this is I really don't blame people for leaning in this direction and getting comfortable with the idea of it. But this whole idea of like investing just for dividends or being overly fixated on what's the yield of my portfolio, how much income is it generating? I need to change to an income focused portfolio because I'm retiring. I am here and ready to hear you debunk and poke holes into that strategy.
You found the topic that maybe drives me up the wall the most when it comes to talking to people about their investment strategies. And you're absolutely right. I don't blame the people. who prefer it. Like, there's a lot of good reasons why people look for income, and it feels safe. What really bugs me is when it's other financial professionals who are managing this way, but I'll get there because that's like a real client story I have. But before I start yelling and screaming, let me ask you, when you're talking about like income, right? So like let's say you're not working anymore, you're retired, and you need income. What does that mean to you?
Well, I think from the eyes of the client, it means interest and dividends from the portfolio. What it means to me as a planner is the paycheck they need their portfolio to generate for them to live off of, which could be any combination of interest, dividends, or capital
Exactly.
gains.
Right, absolutely. Like if I'm trying, like, you're a W-2 employee before, you had a job, that's what you considered your income. You're retired now. You're just trying to replace that money in your bank account so that you can pay your bills, go on trips, live your
Yeah.
life, right? That's income. That's what you care about, right? So the source of the income doesn't matter, right? And so when we think about what does matter when it comes to investing, what matters is the total return for your portfolio. Because at the end of the day, there's a couple main sources of return that will accrue to you. You've got price appreciation of your securities, right? Especially if you're investing in stocks, you can expect that to be a major
Hmm.
driver. And then you also do have dividends, which can come in the form of dividends, or it can be coupon payments from bonds. It can be premium payment from option strategies, all sorts of stuff. But really, at the end of the day, you care about price appreciation plus dividend yield. And what you really should care about those is, and this is the point that a lot of people leave out, is you also need to make sure that you're maximizing this after
Hmm.
taxes as well, right? So there's a couple points there that I'll get to into it in a second. But when we think about like what a dividend is, right? So we'll just remove certain asset classes like bonds, or really income is how they grow, right? But let's just focus on stocks for a second, because stocks really do most of the return is from price appreciation, and then some stocks pay dividends, some stocks don't, right? And I get what people, when they receive cash into their account in the form of a
Mhm.
dividend, right? That feels safe. That feels like it's cash.
I'm not
It
touching the
can't go down,
principal.
right? Like, I have that in my portfolio. That is return. Right. That return is mine. It's interesting. I'm protecting principal. You say that because when you look at what happens, I wish that we could reframe dividends as a society as a forced
Hmm.
sale, because you're not protecting your principal, right? As soon as the stock goes ex div, what happens is you, as the shareholder, are entitled to the dividend that's going to get paid out, usually a couple weeks into the future, and the price of the stock goes down by the amount of the
Hmm.
dividend, right? Because that's cash that's on the company's balance sheet that is now going to shareholders, right? And it's no longer there, so your share price drops. So in effect, it was a sale. And if you think about it, the way that dividends get taxed, they get taxed like a sale, right? Basically, it's like your long-term capital gains tax for qualified dividends, right? So it's not that your principal is being protected; you're just receiving cash. And what drives me crazy is people will be like, yeah, I want income, but I also want a drip set up, like a dividend reinvestment program set up, right? So now what you're doing is you're essentially selling and immediately rebuying, and you're just having to pay taxes along the way as you do this in the form of those dividends. So it just drives me crazy, because dividend income, while it does feel safe, at the end of the day, you just it's a forced
Yeah.
sale. Like that's just the cleanest way to put it.
Yeah, and you're boxing yourself in from like a planning
Um,
standpoint.
yeah,
You're kind of boxing yourself in from a return standpoint and from a tax efficiency standpoint, like you said. So it's just you're losing flexibility.
you're losing flexibility. And I know, like, a couple years ago, there was like all this political pressure on share
Hmm.
buybacks. And I never really understood why share buybacks had all this. Like, it's a really kind of like esoteric corporate finance move that companies do, or essentially a company that the whole reason they do a share buyback is actually the same reason why they would pay a dividend. They just have all this money, all this cash on hand. They don't have a productive internal use to reinvest that cash back into the company, so they pay it out to shareholders, right? Because at the end of the day, a company, its job is to maximize value for shareholders. And so basically, what a share buyback is it's a company saying, my shares are undervalued by the marketplace. We're going to buy them back. And what happens to the end investor, though, is the benefit they get from a share buyback is exactly the same as they get from a dividend, right? So in the dividends case, you get cash, the share price drops. In the share buybacks case, the cash gets used to buy back shares, but now you own a bigger slice of the pie, right? You've got a larger claim on the share of earnings, or the claim of earnings per share for the company, right? And so if you look at it mathematically, you actually end up with the exact same benefit as you would if you received a dividend, but you don't have to pay taxes, right? So that's why I really didn't understand why everyone was freaking out about share buybacks. And I know now that, there's a 1% excise tax on net share buybacks, which kind of makes the math tilt back maybe a little bit more in favor to dividends than it otherwise would. But like a share buyback and a dividend are the same thing. If you really go drill down into the math, and that's, if there's one thing the CFA exam really hammered into my head, it's that point right there.
Yeah, it's part of the Washington, politicking. It's like, grabbing on to one thing connected to Wall Street and really beating it down. And it certainly was in the headline. And yeah, you're right, that 1% excise tax, that was part of the Inflation Reduction Act of 2022. Which, feels like it was a really far in the rearview mirror, but we're still, reeling it.
In which you also made content
Yeah,
about.
of course. Add it to the tax bill list. But also, Andy, on this, there's some really great, I think you conceptually explained that really well, but there's some awesome data behind this as well. And I think the one thing that I've always leaned into when talking to clients is if I were to ask you what's the return of the S&P 500 since inception, most people give me an answer somewhere around 10% annualized, right? Stocks over many, many decades, you can expect a 10-ish% annualized return. Of that 10% per year return, only about 2.5% of that represents dividend income.
Yeah.
Most of your return, if you think about it as specifically someone transitioning to living off their portfolio, and what I mentioned about loss of flexibility is clearly a majority of the return of the market is coming from something other than dividends.
Yeah, so you need that price appreciation, right? Like if 2.5% is dividends, and let's just say 4% is the rule of thumb for drawing down from a portfolio sustainably, it needs to come from other places anyways. And so this like that this point on income, it kind of segues to something. So like we launched this podcast because I mean we get all sorts of great questions from clients all the time, and we wanted to share that more broadly. And one of the things that we do through our line of work is I'll see what other advisors are recommending for their clients, and we'll see account statements, and we'll analyze them. I got one recently, and I've been seeing this more and more, where it was a person who's wanting to transition to retirement. And so income was a big point, taxable money. And this advisor put virtually all of the portfolio into those like JP Morgan premium income funds, like JEPI and JEPQ, I think are the two big ones. Are you familiar with those at all?
Not to a great amount of detail, but I know that they're super popular in the retiree community. They do a heck of a job marketing them.
Yeah, smash hit from JP Morgan. Yeah. Right. Oh, and think about how they basically rebranded covered calls to premium income. It's like that Pooh Bear meme where it's like covered calls and it's Pooh Bear in a tuxedo, premium income.
Right. Yeah. Covered calls sound
and
sounds wealthy.
Absolutely. And I despise these products, especially when that recommendation is coming from another advisor, because it's the ultimate in focusing on the wrong definition of income. So people buy these things because they are marketed to be, it's the S&P 500, but with a 10 to 12% dividend yield. And so now you're like, oh, great. Like this is what people think is I'm going to get the return of the S&P 500 plus 10 or 12% in dividend yield. And that's not at all what happens. What happens instead is you get exposure to the S&P 500, but with a covered call strategy overlaying this. And I don't need to get into the details of a covered call and exactly mechanically how it happens or how it works. But essentially what it is it's an option strategy that is used to generate income, but it provides a cap on upside, right? So in a big bull market, what you're going to get is you're going to get your income, but then if the S&P 500 has a really good month or year, you're not gonna see those types of gains, right? Perfect example was last year, S&P 500's up mid 20s. The JEPI product was up like low teens. And the reason for that is the income that's being produced. It is a lot of income, but it's totally capping your upside. Um, and some people say, okay, well, it does provide some cushion on the downside, and that's true for like a modest downside, right? Because this if the stock market falls, you've got these covered calls that are actually adding to
Yeah.
performance to a point.
Yeah.
But if the bottom falls out of the stock market, you're still participating in all those losses. So it's not a hedging strategy at all. There's maybe a little bit of modest protection, but it's modest at best. But I think the worst part about this is taxes on income from covered calls are not advantaged like they are from dividends. About 50 to 70% of, and it varies by year, but historically about 50 to 70% of the income that's being kicked off by JEPI is taxed at your ordinary income tax rates, right? So not only are you capping your upside, it's a really tax inefficient way to get income. And so when I saw that advisor recommend this for a future retiree's portfolio that was primarily taxable money and had them completely in, these JEPI products, I was like, this is maybe
Yeah.
one of the worst recommendations I've ever
Well,
seen
yeah,
from
it's
a
a sales
professional advisor.
tactic. It's a sales tactic, and it simplifies things so much if you're that type of an advisor, right? If you're just like, hey, here's your portfolio, it's going to kick off what you need, live off the dividends. People feel so warm and fuzzy when you describe things that way. But if I could put a little bit of a planning angle on this, I've got some, let's call this qualitative reasons against this income investing as well. Number one, and I've seen this play out a couple of different ways. So number one, I've worked with clients that have said, "Hey, I'm going to amass X amount of wealth, and assuming a 3% dividend yield, I can just live off of the income and um, and never touch, the principal." And I think this does a few things. Number one, it helps them kind of replicate a fixed income lifestyle, and number two, it gives them this feeling of like having this war chest of principle there sitting in case they need it. But I've actually found more often than not when people follow this strategy, they end up having to work longer, they end up having to save more, and they ultimately have this big bucket of principle they never tap into and never get to enjoy, and then they end up just blindly leaving it to family. So it brings forth a lot of different challenges in terms of just what you want your life to look like in retirement and boxing yourself in. I've said flexibility probably 15 times already, but it greatly reduces your flexibility and earmarks this kind of esoteric sum of principle for a random future event for a future purpose. And the other thing that I've seen is um, if you think about it, and if there's a timing element to this too, but if you think about all the I think exciting things that happen when you go to retire from a planning standpoint, things that you have to take advantage of, let's say you have various different types of accounts. You've got pre-tax money, Roth money, HSAs, brokerage accounts. There's so much planning that can be done to bolster the longevity of your portfolio and help you really live that optimal retirement that you're gunning for and reposition your assets, doing Roth conversions and things of that nature. And an income strategy really it puts you on your heels from a planning perspective. It limits immediately what your kind of what your options are and what that looks like in retirement. So that to me is, if you build a really well
Yeah.
diversified portfolio, there is going to be some sort of a reasonable dividend component. But I guess like between shooting for a 2%
Hmm.
dividend yield and a 4% dividend yield, how much are you giving up in between that 2%? It's got to be significant.
Yeah. Yeah, people never like it's rare that people consider the opportunity cost of doing something else that might still achieve the same risk goals for a portfolio, have less income, but at the end of the day be better from an after tax total return
Right.
standpoint. And again, after tax total return that's what you really need to be caring about when it comes to your investment. And I love this concept that you're talking about when it comes to like flexibility, because like one of the things that I think about is, you know, take control of your income, right? When it's a dividend strategy, you know, you've got no control. Like the income number is going to be the income number, right? But what if you don't need all that income and now you're paying taxes on it at the end of the year? I'd much rather, you know, when I need to take $10,000, $20,000, whatever it is out of my portfolio, sell it at that time, take the money out, right? So that I'm in control, not just some random, you know, income
Yeah,
strategy.
yeah, and think about really bad stock market environments. Whether it's market wide or for an individual company, you know, say you're a shareholder in a company with a 5% dividend and the stock falls 30% and it stays there or it takes a long time to recover, do you think that dividend is sustainable, you know, indefinitely? Uh, Probably not, right? I mean, at some point
Yeah,
they're like going to be thinking
yeah,
about cutting the
probably
dividend
not.
or suspending it, even worse.
And I know companies that they really hate to cut the dividend because it's going to be a bad day for their share price, so they avoid it if they can. But it's inevitable at a certain point, where a decline like in that same decline, let's say we get like a 2022 type stock market where the market drops 20% and kind of stays lower for a little bit while, like a while, maybe going. I don't want to go back to 2008, but just some long downturn. If you're running one of these option strategies, you're running these covered calls over the value of the principal. So like your income's falling, you know, along with the market as well,
Yeah.
right? So it's not like, you know, a 5% dividend yield, you know, on a $1 million portfolio. You know, it's going to drop if the portfolio drops to $800,000, that dividend's going to drop too.
And where do you draw the line? You know, right? Because effectively, if you're a business, you've got two options with your excess cash. You can return it to shareholders or you can use it to grow the business, either through acquisitions or, you know, R&D and new product lines and
Mhm.
hiring. So,
Yep.
right, like the nature of a high dividend paying stock or investment is a little bit counterintuitive, right? At beyond a certain point, you're like, okay, sure, you're generating enough cash to pay the dividend, but like, what about 10 years from now? Are you not investing in anything for the future? Is there something I should be worried about? Um, and that's why you see stats that show,
Right.
right? Like, if you look at the market as a whole, that's exactly why you see certain stocks many times that don't pay dividends or that pay lower dividends, you know, with stronger total returns over their lifetime because they're putting that cash to work and growing it. And
Yeah.
I would rather that.
Right. If you're focused on dividend income, what do you avoid? You're not buying Nvidia, you're not buying Meta, you're not buying these like high flying tech stocks that have done so well. You know, I'm not saying, you know, people load up on those too much as well, and I'm not saying that you should do that either, but like if you only focus on dividends, you're just cutting an entire area of the market out
Yep.
that has generated fantastic returns over the last 10 or 15 years.
So I think we can wrap up this dividend conversation with
Yeah.
um, this was put out on Twitter by Peter Maluk. Over the last 50 years, U.S. inflation up 6 times, S&P 500 dividends up 21x, S&P total return up 255x. So that's kind of like the whole conversation around
That number sounds bigger.
income. Yeah, which number sounds bigger, 6, 20, or 255? That's exactly what we're dealing with here. So that kind of gives you, instead of like the annualized return approach, it's like it's like, you know, over 50 years, how much more would your money grow just looking at dividends alone versus total return?
Yeah.
So, um, yeah,
Right, exactly. Just reframe dividends as a forced sale and focus on after-tax total return, please. That does segue nicely though, because we oftentimes get into these income dividend, you know, type questions with people as they approach retirement. And I think that, I mean, you work with people who are nearing that decision all the time. It's been relevant for me, especially lately, I feel like as well. But one question that people seem to always like struggle with is, how do I know when I'm ready to retire? What advice would you give for them?
so I would say the whole decision of retirement readiness, there's three legs to it, essentially. The first is, should I retire? The second is, can I retire? And then the third is, how do I do it? Um, the first one, I feel like the should I retire question is in your average typical retiree is given the least amount of significance in the equation, which I don't agree with, but I understand the root of it. It's we obsess so much about the numbers and the math behind, how much do I have and can I live off of this? And I understand the nature of that conversation, but the whole should I retire thing is huge because I've seen in practice so many times where this question has been neglected and they go in on a Friday and it's their last day of work. They get the sheet cake and the balloons and the party and the big farewell send off. And then Monday they wake up fully retired, ready to go. Life is good. And it's just this blur. It's like, okay, well, like, what do I do now? And you can only play so many rounds of golf and take so many trips. There's got to be intentionality behind it. And so I really do think that looking into the should I retire, thinking about almost taking a blank calendar and pretending you're retired and saying, how am I going to fill in my time? Totally understand if there's this massive wave of travel early.
I love that exercise.
Yeah, if you're like really excited to travel and you've got home projects and you've got family you want to visit, that is fantastic. But try and think out a little bit beyond that and see what am I actually going to be doing? And retirement is not this binary thing. It's not, hey, I'm all in or all out. I think people are warming up to the idea, and I certainly encourage it where it makes sense of, some sort of a phasing out of full-time work, whether it means going from full-time to half-time to part-time, and then you're done. Whether it's full-time to some form of significant volunteer work. I think there's so much psychologically that goes into the
Mhm.
community of a job and the purpose that people get from their work, um, that you really need to dig into that and think realistically about what that looks like because you can be prepared to retire and this kind of transitions to can I retire? You can answer yes to that can I retire question, but still continue to work. And honestly, I think sometimes when people do that, they have some of their best years of work with that sense of freedom hanging over them. Um, to kind of support them and know
Right.
that, hey, I'm okay no matter what happens at work. And that goes to the
Right.
second
Yeah,
piece.
it's interesting. I feel like I hear a lot from people. Yeah, no, sorry, Adam. There, I feel like I hear a lot from people. It's like I still want to be busy. I still want to have purpose and do something, but I don't necessarily want it to be a 40-hour work schedule,
Yeah.
right? I want to have some control and flexibility of my calendar, right? So I feel like we get that a lot. Look, that's getting to some of the things you're talking
And
about.
I think it's ramped up since COVID, honestly. I don't know if it was just this really prolonged period of being stuck at
Hmm.
home, the volatility around everyone's work schedules and when they were in the office and not. Something about that, it did one of two things. It did force some cohort of people to retire, especially accountants, with all the tax changes that happened then. But like, it it either forced people out of the workforce like cold turkey, or I think philosophically got a lot of people thinking and asking these other questions. So we encourage, and I think part of the role of an advisor is to talk through those things with your clients because this second piece of the equation, the can I
Hmm.
retire, is the conventional way to look at this. It's okay, let's look at your assets and your liabilities. What are the structure of your various types of accounts? Your tax diversification. How much do you have in brokerage versus pre-tax versus Roth? How much are you going to spend? What do you need to plan for healthcare? Anything under that umbrella of retirement and finances is covered in this second piece of the process. And I would say on that front, some of the things to really emphasize are the nonlinear nature of this retirement horizon, essentially. It's there's all kinds of calculators and tools online where you plug in a number and it takes a certain percentage of it and says, hey, you can live off of this and you're going to be good. But it's really fluid. I would say that I don't like making absolute statements, but I'm always very, very pleasantly surprised if someone nails their retirement budget, like right out of the gate. Like it's so volatile, whether it's the expenses you didn't know were coming on or off of your budget books, or you travel more than you thought you would, or healthcare is more expensive than you thought it would, or you need to end up supporting some of your kids, like it's just so volatile.
Yeah. How can you know until you live it?
So exactly. So I think so much of that, we could talk all day about Medicare and Roth conversions and retirement distributions and the portfolio aspect of it, but I think a lot of it is setting expectations with yourself that these are guardrails. Your spending might fall within a certain range rather than hit the bullseye. Your portfolio is going to be, variable through time. The tax code, uh, the whole retirement process is very, you need to have some level of flexibility when you go into retirement because you don't want to get thrown off your game and get anxious and, if everything's not hitting to the T as you expected. So that's a big piece of this. But the can I retire is important. You should start that. People like starting that really early, like even in their 30s and 40s, just because they want to know if they're on track and they want to know when they can hang it up, even
Yeah.
if they don't plan on doing it. Um,
Right. Well, I mean, those people who are still 15, 20, 30 years from retirement, right? Like you are still making decisions that will have a material impact on that can I
yeah,
question. Because we know that, money compounded over a long time frame can really, really grow. And the later you start, the harder it is to catch up.
yeah,
Right. So
yeah,
like it's that can I question, I think basically starts the first time you open a 401k with your company.
yeah. And a lot of people, I would say, of all the three main questions, this is the one that everyone is most comfortable with because that's just like the conventional, hey, what do I have and what am I going to spend? The nuts and bolts of retirement planning. Most people, when they think about this, they get it relatively close, right? If you've got a certain amount of money, roughly what you can spend. But the third
Mhm.
one is really fun because I think this is equally as neglected than the should I retire question. It's how do I retire? And what I mean, this is the implementation of the retirement plan. And it's really funny when people retire hearing them say, like, okay, I've got the money. Like, now what do I do? Like, what's next? Like, do I just like call you every time I need money? Do I, you know, send a lump sum every year to my bank
Mhm.
account? Like, what and where do I pull it from? And, should I change my portfolio? Like, this is the part where we really get to put the academic side of retirement planning to practice and deliver that peace of mind because, I love conversations around generating a paycheck from your portfolio, tax efficiency, hey, the first year of retirement, it might make sense to pull your money.
That sounds like what we were just talking about with dividends.
Yeah, yeah, it might make sense to pull the money from a taxable account, but it
Sorry.
might make sense to pull money from a pre-tax account. I mean, like everyone's circumstances are so unique. So the how do I retire
Mhm.
is something that's repeated every year, and and also warrants a huge amount of flexibility because this is like I think for most people, and this is where I find that retirees start to get really excited and just are focusing on having fun and living in retirement. They know that whatever they need to live off of is hitting their bank every month, and it's our job to figure out the best way to generate that. Um, and so I think the how do I retire piece is where the advisor and the client are really the implementers. Like they're doing this proactively together and not leaving things to
Like a
chance.
team, huh? Right. Yeah, that's fascinating. Yeah, there's so many decisions that are made post-retirement, right? It's like that in and of itself, you need your own guide for.
Yeah, sometimes people, like
Yeah,
Life
it's
changes. I mean, things change so quickly. People decide to go back to work, whether it's health, whether it's family considerations. Nothing is linear in the world of retirement. Your spending habits change. It's really, I've had clients decide to buy a second home somewhere and they move there and they don't like it, so they're moving again. So things happen, and I think that's you know really framing the retirement conversation more around, okay, I can play. You're defining a sandbox essentially, and saying here's the spending level, here's kind of the tax level and the portfolio risk level I'm comfortable playing in. And as long as I stay in the sandbox, I'm fine. And the advisor's job is to tell you, we're like the person at recess that blows the whistle when you leave the playground, right? We just got to keep you in the zone.
right, right. And it can be a wide zone. That's interesting. So it's almost like the way you think about it is like there's the three questions: should, can, how. Should I is like, how will I find purpose? Right? Can I, is this prudent? And then how is like, how, let's implement this retirement together. Right? That to me seems to be like the big picture theme for each of those
Yeah,
questions.
like how do I do this? Like, what do I do? Because so much of conventional rule of thumb planning is, hey, you need X amount of dollars by this age to retire. And that's your pet peeve is dividends. My pet peeve is that because what are you spending? What's your health? Where do you live? Right? Someone who's got $1 million uh, in one part of the country is a lot different than $1 million in, Orange County, California. So it's someone with a
Sure.
million bucks in Alabama is living a lot differently in retirement with a lot, a certain level of flexibility that someone in New York City with $1 million isn't, and health and all those other things. So it's all about the personal and personal finance. So that's why, just like with this new tax bill, you just see information come out that just makes you scratch your head. The same thing comes out with retirement planning.
Well, I'm a long ways off from retirement. I'm pretty sure you are too. But what I'm going to do when I get home is I'm going to look at a blank calendar and I'm going to try to figure out how I would fill that space because honestly, I'm not sure how I would do it.
Yeah, I don't, yeah, that's hit the golf course.